How is everybody doing tonight? Welcome to the Strategy Room. We are live here on Saturday night, March 22nd, 2025. I hope everyone is having a great weekend so far. You are here with the banker next door, your host, Dr. Joe Berquist. As always, I have a jam-packed night for everybody. Tons of economic things to talk about, tons of incredible articles and business-related things happening this week. We got the Boston Celtics selling for crazy numbers. We got all kinds of crazy things happening this week. But I'll tell you what, let's jump right into a couple things here. So the first thing here is we will take a look, as we do every week, and take a look at our Doge clock here. And as we look at this, is actually the U.S. debt clock. We're going to check in and see how things are going so far. So our good friends over at Doge so far have saved us over $200 billion is what they're showing here so far, which is pretty incredible numbers, I think, so far. Approximately $231 billion, and they're calculating their savings per taxpayer at a little over $2,000 per taxpayer, about $2,059. So, but our unfortunately national debt still hanging out there at $36 trillion. Federal budget deficit still at $2 trillion, and our debt to GDP ratio is still 122%. So still a lot of bad numbers up here that we're looking at, unfortunately. But we will come back to that in just a second. So I thought this was interesting. I saw this week, and I just thought I would share this with all you guys here. So this is basically an article from Zero Hedge. It basically says, huge win, corporate America embraces Doge. So despite conspiracy networks across the leftist corporate media and unhinged Democratic lawmakers ranting about the so-called evils of Elon Musk's Department of Government Efficiency, corporate America begs to differ. Now, there's a bunch of kind of X posts in here, but I'll just look at some here. So small and large business CEOs seem to be considerably more confident under Trump. So that's a good thing. But let's keep going down here. But yeah, see, like I said, this was kind of a little bit what I was looking for here is, Bloomberg data shows that industrial and technology companies mention Doge the most on earnings calls. So Doge is talk of the town in earnings calls. So number of Russell 3000 companies that mention Doge and associated terms on earnings calls. You can see industrial here, the first quarter of 2025. A lot of these numbers way up. We got real estate, industrials, technology, healthcare, energy, communications, consumer discretionaries, financials. So infrastructure software providers like Okta told investors the agencies we've been successful in is because we've been able to consolidate and replace and really help modernize those applications. Pure Services Now CEO told investors it saves the federal government millions and millions in costs by hours by improving efficiency and making mind-numbing. Northrop Grumman CEO Kathy Warden noted that companies have been cutting costs in general. It is a response to competition and staying cost competitive, and the government doesn't have that. So it is sensical that might be where Doge starts. Booz Allen Hamilton CEO Horatio Rosansky views a much shorter period of adjustment followed by a real clear set of opportunities in the era of Doge. Do note Booz Allen Hamilton receives about 98% of its revenue from the government. Top 20 companies with high U.S. government exposure. So basically percentage of revenues from the federal government. We could see it down here, and all of these companies have over 50%. So V2X, DLH Holdings Corp., Science Applications International, Booz Allen Hamilton, Easterly Government Properties, CACI International, Amentum Holdings, Telos Corp., Leidos Holdings, Northrop Grumman, Humana, WidePoint, Carmen Holdings, Leonardo DRS, Huntington Ingalls Industries, Retractable Technologies, BWX Technologies, L3 Harris Technologies, Aero Environment, and Micropack Industries. So just like I said, just kind of some interesting things there that a lot of these CEOs are talking about Doge and talking about them in a positive light, which I think is a good thing. considering all kind of the just, a lot of the negative stuff that's been out there in the corporate press right now. But like I said, so just something interesting that I saw that I thought I would note there to kind of start off. So, but let's take a look at the big news of the week. So let's jump to this first. So the Federal Reserve obviously had their big meeting this week on Wednesday. Federal Reserve just decided to hold interest rates steady. We can see here from the CNBC article that the Fed holds interest rates steady, still sees 2 cuts coming this year. Now, a whole lot to unpack here. We're going to look at the Federal Reserve's balance sheet here in a second. We're going to look at the official statement from the Federal Reserve. We're going to look at a couple articles about the Federal Reserve. What does some of the Fed governors think? What is the Bank of CEO, or what is the CEO from Bank of America think about all this at the moment? And then we're going to look at a couple of articles on the Treasury Secretary, Scott Bessent, and some of the things that he's doing and why, Wall Street may be fretting about that. But I'm going to point something out to you here in just a second. You're going to see kind of some hypocrisy, if you will, on the part of the media, which I'll point out here in the next couple of minutes as we kind of make our way through these articles. But like I said, let's start off here. So the rate-setting Federal Open Market Committee kept its key borrowing rate targeted in a range between 4.25 to 4.5, where it has been since December. The FOMC downgraded its collective outlook for economic growth and gave a bump higher to its inflation projections. Officials now see the economy accelerating at just 1.7% pace this year, down 0.4 percentage points from the last projection in December. So that's the GDP. They're calculating the GDP for the year, and they're saying on an annual basis, not a quarterly, but on an annual basis, the U.S. government is only going to grow at 1.7%. That's not good. That is very anemic growth, and it's really not where the current president wants to be. I'll put it that way. In addition to the rate decision, the Fed announced a further scaling back of its quantitative tightening program, in which it is slowly reducing the bonds it holds on its balance sheet. Okay, we're going to get into that in just a second here. Like I said, we're going to show this chart here. So I think the big takeaways from here is that basically what the Fed was saying was that, okay, we're holding rates steady. We do potentially see some rate cuts coming down the road. However, they're looking right now basically at their balance sheet. They think inflation is going to go up. They think that GDP is going to be pretty weak, and they think that the labor market is kind of holding steady. Therefore, they're basically not going to do anything at the moment. That's the real big takeaway. So the Federal Reserve is closely watched. Decision Wednesday held the line on benchmark interest rates, though still indicated that reductions are likely later in the year. Faced with pressing concerns over the impact tariffs will have on a slowing economy, the rate-setting Federal Open Markets Committee kept its key borrowing rate targeted in a range between 4.25 and 4.5%, where it has been since December. Markets had been pricing in virtually zero chance of a move at this week's two-day policy meeting. Along with the decision, officials updated their rate and economic projections for this year and through 2027 and altered the pace at which they are reducing bond holdings. So you can see here just a quick chart. We saw that basically they had the last cut there, and then we got down a couple more cuts there at the end of 24, which took us down to where we are right now in 2025. So despite the uncertain impact of President Donald Trump's tariffs, as well as an ambitious fiscal policy of tax breaks and deregulation, officials said they still see another 0.5 percentage point of rate cuts through 2025. The Fed prefers to move in 0.25 percentage point increments, so that would mean 2 reductions this year. Unless there is an election coming up, in which case they will move 0.5% right before the election. Okay, they didn't say that in here. I just added that in here. Sorry. And investors took encouragement that further cuts could be ahead, with the Dow Jones Industrial Average rising more than 400 points following the decision. However, in a news conference, Federal Reserve Chairman Jeremy Powell lied his butt off. No, I'm just kidding. I'm having too much fun with this right now. Said the central bank could be comfortable keeping interest rates elevated if conditions warranted it. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer, he said. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Uncertainty has increased. So, in its post meeting statement, the FOMC noted an elevated level of ambiguity surrounding the current climate. Uncertainty around the economic outlook has increased, the document stated. The committee is attentive to the risks to both sides of its dual mandate. The Fed is charged with the twin goals of maintaining full employment and low prices. At the news conference, Powell noted that there had been a moderation in consumer spending, and it anticipated that tariffs could put upward pressure on prices. These trends may have contributed to the committee's more cautious economic outlook. Now, I will say this, Jeremy Powell was asked about tariffs. Will tariffs cause inflation? And Jeremy Powell really had no answer for that. He's like, well, he danced around it. He danced around it like a champ and really gave no definitive answers to anything there. And that really turned into a big problem for him. Sorry. And it just, again, he's struggling right now with gas prices coming down, with egg prices coming down, with inflation beginning to ease off this last report. All of a sudden, his kind of boogeyman on the tariffs of like, oh, the tariffs are going to spark this massive inflation and we're going to have big problems and this and everything. At least for the moment, that argument's not really holding much water. So he is really struggling there with that at the moment. Sorry, guys, I got something in my throat here. So the central bank will now allow just $5 billion in maturing proceeds from treasuries to roll off each month, down from $25 billion. However, it left a $35 billion cap on mortgage-backed securities unchanged, a level it has rarely hit since starting the process. Fed Governor Christopher Waller was the lone dissenting vote for the Fed's move. However, the statement noted that Waller favored holding rates steady, but wanted to see the QT program go on as before. The Fed indirectly cut rates today by taking action to reduce the pace of runoff of its Treasury holdings. Jamie Cox, managing partner for Harris Financial Group, said the Fed has multiple things to consider in the balance of risks, and this move was one of the easiest choices. This paves the way for the Fed to eliminate runoff by summer, and with any luck, inflation data will be in place where reducing the federal funds rate will be obvious choice. Okay, so now let's take a look at a couple other states, a couple other things here. So here's the official statement here, and I want to just run through this. So, recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve a maximum employment and inflation at the rate of 2% over the long run. Uncertainty around the economic outlook has increased. The committee is attentive to the risks of both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 4.25 to 4.5%. And considering the extent and timing of additional adjustments to the target rate for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. Beginning in April, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from $25 billion to $5 billion. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at $35 billion. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. Okay. So, what does all that mean in English? What it means is the Fed is not going to do anything to help you or I. That's what that means in English. The Fed is basically said, we're going to go over here on the sidelines. Jeremy Powell is going to go pout because his bestie, Grandma Janet Yellen, is no longer around anymore, and that upsets him a lot. And and he doesn't like Mr. Trump, so he's going to go sit over here on the sidelines and pout. He's basically taking his ball and he's going home, okay, because he's not going to play right now, and he's just going to sit on the sidelines and do nothing. He doesn't care. Now, let's take a look at a couple things. How is the Fed helping us at the moment? Okay, he reduced rates to try to help the previous administration. Didn't help out so much, but then once that fight was over and the new president came in, he is now, I'm just going to sit here and do jack. But he is going to continue reducing the balance sheet of the Fed, and that's what we have right here. And this gets us into the most important part, perhaps, of the policy statement. As he said right here, beginning in April, so next month, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from $25 billion to $5 billion. However, the committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at $35 billion. So what does that mean? That means this. That means the amount of reduction that the Federal Reserve is going to continue doing on their balance sheet. Now, is this a bad thing? No, it's not. The Federal Reserve tapped out here in April of 2022 at basically just under $9 trillion of money that they had put on their balance sheet. So then they have been bringing it down ever since, and they've got it down to basically about $6.7 trillion. So good job. They've have definitely brought a good chunk off of their balance sheet by continuing to run down. Now, and keep in mind, this is all part of their quantitative tightening policy. Right? Remember, they had quantitative easing, which was basically just turning on the printing press and printing money like crazy and buying everything up. And that's why their balance sheet went up to that $9 trillion mark. So this is the opposite of that. This is basically, instead of quantitative easing, we have quantitative tightening, which is we're going to increase the interest rates and we are going to bring down our balance sheet. We're going to run all this off the balance sheet. Now, while I agree that the Federal Reserve probably should not be reducing interest rates at the moment because we want to keep inflation in check and we want to bring inflation back down, what is one thing that the Federal Reserve could be doing which could really help us out right now? They could stop with the quantitative tightening. And I'm not saying go back to quantitative easing and turn the printing press back on and start buying stuff up again. No. I'm just saying, take your foot off the gas for a minute. Stop with the selling of all the treasury bonds and mortgage-backed securities, or simply letting them roll off. Just leave it alone. Take a break for a couple months. Okay, see what happens. I think just simply that act alone could help out tremendously with our treasury rates right now, and that's one thing that I would love to see the Fed do now. Now they are, like, as he says here in the statement, they are going to start in April. They're going to slow down the pace of the decline of the securities holdings. So that helps, but they're still going to keep the redemption cap on agency debt and agency mortgage-backed securities at an elevated rate of $35 billion. I think they need to bring all that down. Just put a pause on it for a few months. Just say, hey, we're going to hold off on doing that. But Jeremy Powell's not going to do that because he doesn't care at the moment. He's going to do nothing what Jeremy Powell wants to do. Okay, let's take a look at a couple other things here. So, what's this? The Federal Reserve posted a loss of $77.6 billion in 2024. You're kidding. Interest expenses outpaced interest income for the second straight year, though the losses were smaller than the previous year. Oh, that's wonderful. So the Federal Reserve ran an operating loss of $77.6 billion last year, the second straight year of large losses. Those losses are a side effect of the central bank's campaign to aggressively support the economy during the pandemic in 2020 and 2021, and its subsequent decision to jack up interest rates to combat high inflation in 22 and 23. So the inflation that they caused by spending all that money. So you see how that works? So they spend all the money, cause all the inflation, and then they run out there and say that it was transitory, okay? And then they have to jack up the interest rates to now bring down said inflation that they created, okay? But hey, that's all on us, right? And now they've created all these losses for the last 2 years. So now they don't require the Fed to ask for any money from the Treasury Department and don't affect the day-to-day operation because the Fed can just print money out of thin air. So of course it wouldn't. The figures were disclosed Friday when the U.S. Central Bank published audited results of its 2024 financial statements. The Fed reported a loss of $114.3 billion in 2023. And here we have this lovely chart showing these massive losses. Now, from a very technical standpoint, what does this mean at the moment? Does the Fed have to report these losses? No, because if they had gains, if they had earnings, those earnings would go directly to the Treasury. They basically just send all the money they make, they send it over to the Treasury. Good thing, right? Okay, that's nice. When the Fed has these losses, however, what happens is they basically, you could think about it like the losses pour into a bucket, and the bucket just builds up. So now what happens is, though, when the Fed does eventually get back to break even or does eventually have a profit again, that profit does not automatically go back to the Treasury. They have to first work off all these losses. So they had $114 billion in 23, and now they got about $78 billion this year. So they're running up about $90 billion in losses right now that they are now going to have to work off before they can get $1 in profit back to the Treasury. So not great. That's going to take them quite a few years. Again, they had some good year here at 21, $109 billion in profit because of all the money they printed. 86.9 billion, 54 billion, 65 billion. Again, you can see here when they had quantitative easing, they were pumping money here through from 2010 through 2015. So profits were good. You notice here the profits were a little bit more meager in the years leading up to the financial crisis, and they didn't really take off until they started doing massive quantitative easing, and then all of a sudden earnings were real good. And then it started to come down here a little bit as they took the pedal off. But then we had COVID, and then boom, earnings way back up because they're printing the money. They had the money press rolling. So the reason why I point that out is because if you're not doing quantitative easing and you're not spending massive amounts of money, profits are generally going to be a little bit more muted. You're probably going to come back in here at this range of 25 billion, 27 billion. So if that's the case, if you're around 25 billion in profit, how long is it going to take you before you get back to break even when you're 200 million in the hole? That's going to take you quite a few years. It could take you probably about 8 years to get back to even. But let's continue on here for a second. So generating profits and interest income isn't a specific goal of the Fed, but rather a byproduct of its conduct of monetary policy, which aims to keep inflation low and stable with a healthy labor market, or so we've heard. Until 2022, the Fed almost always turned a profit like magic, and it often returned hefty sums to the U.S. Treasury last decade when interest rates were low. But over the last 2 years when rates were high, the central bank's costs exceeded income due to some complex monetary plumbing. This is, like I said, it's called turning on the printing press and turning it off. That is the complex monetary plumbing. Okay, just remember that. It used to set short-term interest rates, but you know what? They decided to turn that over to Grandma Janet Yellen in the last couple of years because, they didn't want to be seen as being overly political. But I digress. The Fed's balance sheet includes assets such as Treasury securities and mortgage-backed securities on which the central bank earns money like any other investor would. On the other side of the ledger are liabilities, including deposits that banks maintain at the Fed known as reserves. It pays interest on those reserves to the big banks. that hold them there, like Bank of America and JP Morgan and Wells Fargo and Citibank and Morgan Stanley and Goldman Sachs. When the Fed raised interest rates rapidly in 2022, it steadily had to pay financial institutions more money on those reserves. By September of that year, the Fed was paying more on interest than it was earning from its portfolio of securities. In other words, that's called being underwater. If a regular bank was underwater that badly and has sustained losses like that, they wouldn't be around very long. But because of the Fed, if they're in their superpowers and the ability to do what they do, they are able to sustain this. Because the Fed is self-funding, meaning it doesn't receive money from Congress. Instead, it covers all operating expenses out of the income it earns on securities and sends the rest to the treasuries. And it has a magic money machine that it can turn on anytime it wants. The Fed also funds the operation of the Consumer Financial Protection Bureau. Ain't going to need to do that much longer. Congress required it to do so when it created the agency through the 2010 Dodd-Frank Financial Overhaul Law. Unlike federal agencies, the Fed doesn't have to go to Congress hat in hand to cover operating losses. Instead, the Fed created an IOU in 2022 that it calls a deferred asset. Isn't that wild? When the Fed is no longer running losses, it will pay itself back first and extinguish the deferred asset before resuming its previous practice of sending profits to the Treasury. Wow. I kind of know a little bit about this stuff. So the central bank maintained a relatively small portfolio until the 07-09 financial crisis. After that, the Fed's net income soared as it held short-term rates at low levels while owning higher yielding long-term securities. Between 2012 and 2021, the Fed sent more than $780 billion to the Treasury, including $109 billion in 2021. Notice how they neglect to say that they did the massive quantitative easing of money printing that they use to buy said assets. During the first 9 months of 2022, the Fed transferred $76 billion in earnings to the Treasury. In September of that year, it began running a loss, and it ended the year recording a $16.6 billion deferred asset. The Fed's deferred asset grew to nearly $216 billion in 2024 from $133 billion in 2023. So when the Fed returns to profitability depends on when and whether it lowers interest rates to a level that is below the yield it currently earns on a $6.8 trillion portfolio of bonds and other assets. The Fed has been shrinking that portfolio for the past 3 years. Projections last year from the New York Fed showed the Fed would continue to run losses this year if the level of short-term interest rates remained above 4%, while it would have a profit if interest rates continued to steadily decline. The Fed's benchmark rate is currently above about 4.3%, down from the 5.3% at the start of September. They are getting closer and closer to break even as time goes by, says Seth Carpenter, who is the chief global economist at Morgan Stanley and who previously worked at the Fed and the Treasury. It's difficult for me to see a scenario where they don't get back to managing a net profit, but it could take a couple of years. So Fed not really doing a bang up job at the moment, not really doing much to help us out here. So let's go on to the next thing. So, and this is my favorite one. This is what I was waiting to get to. So Powell contends with double threat of economic chaos and political hostility. Will you show a little lip action there for Mr. Powell? He's got the sads. Federal Reserve is navigating the fog of a trade war from an administration ready to blame officials for any economic slowdown. So not long ago, it looked like Jeremy Powell's final test as Federal Reserve Chair would be to stick the soft landing. Now, with about 1 year left in his term, he faces a serious complication, navigating a trade war that threatens to push prices up while weakening the economy. During a 7-year tenure that including Donald Trump's first trade war, a pandemic, historic inflation, and high-profile bank failures, Powell's final act also unfolds with an imperative to preserve the institution's apolitical DNA that protects its autonomy in setting interest rates. Bravo. This is gaslighting at its highest. Fed policymakers are alternatively referred to as inflation fighting hawks or labor market defending doves. Right now, Powell looks more like a duck, calm on the surface while constantly paddling beneath murky waters. Inflation fell over the past 2 years as supply chain bottlenecks eased and workforce participation rose. Now, tailwinds are becoming potential headwinds. Falling immigration and cuts to federal contracts risk hitting labor supply and demand. Dramatically raising tariffs could create an uncomfortable combination of weaker or even stagnant growth and higher prices. Powell's 18 colleagues who participate in monetary policy meetings have shifted their outlook. A few doves have become hawks and vice versa. At least one has an eye on possibly succeeding Powell next year. I bet they do. But here's the propaganda here. Here's the point of this article. We're supposed to feel sad for Jeremy Powell because he has just been there and he's been so honorable, fighting the good fight. They don't talk about how he has systematically turned the economy on its head with his besties, with helicopter Ben Bernanke and with Grandma Janet Yellen. The three amigos, as I like to call them, they turned the economy on its head for 16 years, did perhaps one of the greatest financial experiments in history. And the sad thing is that one person in a million can't tell you how they did it or the truly the harm it's caused to the economy. But I covered it all in the Lords of Easy Money series. If you want to go watch that series, you'll understand exactly what I'm talking about. It explains everything step by step, how they did it. Go listen to a guy named Thomas Honig, okay, retired Federal Reserve governor from Kansas City, okay? Go listen to Mr. Honig. He will tell you all about it. He will tell you how these three wrecked the economy. And I've said before, the Federal Reserve is like the arsonist that, threw a grenade into your house and blew it up, okay, but then are nice enough to show up 10 minutes later with the fire truck to try to put the fire out. But yet this is what our financial news media does. They just constantly, they're constantly running cover for the Fed. They're constantly, put out these pieces like this where it's like, oh, Jeremy Powell, he's just got so much to contend with. It's just horrible that he's got to spend his last 2 years. He was doing such a good job of getting ready to, land the economy. And again, these terms, the soft landing, the transitory inflation, it's all nonsense. It's all nonsense at the end of the day. You can't, the economy is either going to go into a recession or it's going to be okay. There's no such thing as a soft landing. None. They just made it up. That is a made up term, just like transitory inflation was made up. And it's ridiculous that they do this stuff. But we're supposed to all feel terribly sorry for Jeremy Powell that, the big mean ogre that is Donald Trump is just causing him so many problems right now. And we should applaud him that he's just going to sit on the sidelines now and not do anything. He's taking his ball and going home because he doesn't want to play and he doesn't want to be nice. He doesn't want to share with the other kids, okay, in the administration. He's just going to go back and do nothing. Okay, so thank you for that, Jeremy Powell. We love it. We appreciate it. But let's see here. What do a couple other people think here? So Chicago Fed President Goolsbee sees rate cut depending on inflation progress. So Chicago Federal Reserve President Austin Goolsbee said Friday he still sees interest rate cuts in the cards, though risks are rising to that outlook. The central banker told CNBC that he's been hearing more concerns from businesses in the region about the impact of tariffs. If we can continue to make progress on inflation over the long run, I believe that rates 12 to 18 months from now will be lower than they are today. Now, notice the timing there, 12 to 18 months. That means that basically, yes, when Jeremy Powell is done, okay, and because Jeremy Powell is going to sit and do nothing, okay, so when Powell is done in another 18 months, okay, then we may, when the next guy gets in there, then we may be able to cut rates, but not until then. Not until then. We have to be good. We have to be good little boys and girls and just sit tight and be patient and wait for the Fed to come save us. All right, and there's not really much left to add over in there. Let's see here. So here it says, slower economic growth is likely ahead with risk of a recession rising according to the CNBC Fed survey. So probability of a recession rose to 36% from 23% in January, according to the CNBC Fed survey, which polls fund managers, strategists, and analysts. The average 2025 GDP forecast declined to 1.7 from 2.4%, with tariffs now seen as the top threat to the U.S. economy, replacing inflation. 3/4 of respondents forecast 2 or more quarter-point cuts this year. So respondents to the March CNBC Fed survey have raised the risk of recession to the highest level in 6 months, cut their growth forecast for 2025, and hiked their inflation outlook. Much of the change appears to stem from concern over fiscal policies from the Trump administration, especially tariffs, which are now seen by them as the top threat to the U.S. economy, replacing inflation. The outlook for the S&P 500 declined for the first time since September. The 32 survey respondents, who include fund managers, strategists, and analysts, raised the probability of recession to 36% from 23% in January. The January number had dropped to a 3-year low and looked to have reflected initial optimism following the election of President Donald Trump. But like many consumer and business surveys, the recession probability now shows considerable concern about the outlook. We've had an abundance of discussions with investors who are increasingly concerned the Trump agenda has gone off the rails due to trade policies and Barry Knapp of Ironside's macroeconomics. Consequently, the economic risks of something more insidious than a soft patch are growing. You gotta love this stuff, man. Again, all the fear mongering over the tariffs and I've said it before, I'll say it again. Could we see some pain in the short term with the tariffs? Yes, we absolutely could. Are the tariffs going to pay off in the long run? Yes. Is Donald Trump eventually going to get what he wants from the tariffs? Yes. Believe me, April 2nd is coming. We got about 2 weeks. April 2nd comes, the full tariff package goes on, and my prediction is I give it about a couple of weeks, maybe not even that long, before Mexico and Canada come crawling back and even China, come crawling back and basically say, hey, let's make a deal here. Let's make a deal. Let's do something. Let's try to figure something out here, because this is going to be so much worse for them than it is for us. And that is guaranteed. But anyway, let's keep rolling here. So, so Trump picks Fed Governor Michelle Mickey Bowman to replace Michael Barr as Fed's supervision head. So President Donald Trump announced Federal Reserve Governor Michelle, also known as in the industry as Mickey Bowman, as vice chair for supervision at the central bank. Her predecessor, Michael Barr, resigned from the position. He is still a Fed governor with a term that lasts until 2026. Bowman, viewed as friendly to the banking industry, joined the Federal Reserve during Trump's first term. I actually really like Mickey Bowman. I think she is a very good person to be in that job. Her background, she really came out of community banking, and the industry really had to fight hard to get her into that spot. And since she's been there, I think she has done a very good job, and she's really been an advocate for, mainly for community banks, but I think for banks of all sizes. But I think that she has had a very even-handed approach to the way that she has done a lot of things. So I'm actually excited about this, and I am hopeful that she will do a great job. So President Donald Trump announced Monday that he had chosen Federal Reserve Governor Michelle Mickey Bowman to take over the central bank's top supervisory role. The announcement came after Michael Barr resigned. In January, when Barr announced that he would step down, he said in a statement that the risk of a dispute over the position would be a distraction from our mission. In the current environment, I've determined that I would be more effective in serving the American people from my role as governor, which, if you read between the lines there, that basically means that the administrative told him that if he didn't want to step down, he was going to be removed. So he elected to save face and say, you know what, I'll just step down and remain as a Fed governor, finish out my term, and go from there. So the elevation of Bowman gives Trump someone seen as more friendly to the banking industry in the top oversight role at the Fed. Bowman, a former bank executive and state regulator in Kansas, joined the central bank during Trump's first term. Bowman is expected to take a lighter approach to the regulation of small banks in particular. I am pleased to announce that Michelle Mickey Bowman will be the Federal Reserve's new vice chair of supervision, Trump said in a post on Truth Social. Mickey has been serving honorably on the Fed's board of governors since 2018 and has great expertise dealing with inflation, regulation, and banking. Our economy has been mismanaged for the past 4 years, and it's time for a change. Mickey has the know-how to get it done. I am confident we will achieve economic heights never before seen in our nation's history. Bowman takes over a role that Fed Chair Jeremy Powell is not a big fan of. During congressional testimony in February, Powell said that he thought the creation of a vice chair for supervision had created volatility for the central bank. The position was introduced as part of regulatory reforms after the 2008 financial crisis. Bank stocks have outperformed the broader market since Trump's election, likely in part because of expectations for lighter regulation on the sector. As a Fed governor, Bowman is also part of the Federal Open Markets Committee, which sets the benchmark interest rate for the central bank. The committee is set to convene on Tuesday, which they already did. Hold rate steady, got that. But like I said, I think this is a great thing. I'm really excited. I wish her all the best of luck in this role. I think I'm very hopeful. I think she's going to do a great job. And and again, somebody not wanting to be over the top with regulation does not mean that they are going to be light on regulation, or does not mean that they want, all regulation to go away, or they want to, all they want to do is just, help banks out and get rid of stuff here and there. That is, again, I think that's a big misnomer. Again, it kind of gets, but, I think the press works very hard to make it a very black and white issue of like you either want massive regulation or you want no regulation at all. And what I have found to be true for many years in the banking industry is that banks are not anti-regulation. They are pro-smart regulation. They are pro, if you're going to add new regulation, how about we take some of the old stuff off that doesn't work anymore and yet still adds cost on top of us. There's so much emphasis on new technology all the time, being more efficient, doing things a better way. Then why can't that be the same be true for regulation? If you're going to put new regulation on, that's got to mean that there's some outdated regulation out there that can come off. But that's not usually how the regulators work. The regulators usually like to just continue to dump new stuff, like stacking blocks. They just want to, boom, 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 just stack more and more and more stuff on top of it. And again, I think most bankers understand the need for regulation. Believe it or not, I will tell you a dirty little secret here. In a certain respect, banks love regulation. Do you know why? Because it shields them from competition. You have these things out there called fintech lenders and non-banks. And the fintech lenders, such as PayPal, such as Square, such as Amazon, such as, Bluevine, OnDeck, Cabbage, all these different online lenders, fintech lenders that are out there. The one thing that they all would love to get a bank charter. They would love to get their hands on a bank charter. But the number one reason that they do not is because of the regulation. They don't want the regulation. And this is honestly what keeps them out of the game. So banks do not want to get rid of regulation. They don't want to massively decrease the regulation. I mean, they can handle, 90% of the stuff that's on there. It's just that in more recent years, the Democratic Party has been over the top when it comes to regulation. They don't seem to understand the concept of getting rid of old regulation that's antiquated and replacing it with newer, smarter, updated regulation. They can't seem to understand that concept. It's just simply we're going to get every crazy idea in the book and just jam it in there and just throw it on top and just keep piling the regulation on to a point where where it does begin to strangle the industry because you can't absorb the cost of it. So again, didn't mean to jump on the soapbox there for a moment, but we will continue on here. So, okay. Bank of America CEO says economic growth is better than people think, and the Fed should stay on hold. So, Bank of America CEO Brian Moynihan said Wednesday that consumers are continuing to spend and economic growth should be solid, though slower this year. From a number standpoint, that means gross domestic product growth this year of closer to 2%, from recent trends closer to 3%, according to the CEO. We see the consumer continue to be solid, and that should bode well for the economy, he added. Now, I think that is interesting take, considering the fact that we have seen we've seen Morgan Stanley, we've seen Goldman Sachs. Who else did we see? Maybe a report from Citibank, but we've seen a number of people come out and report to the fact that the consumer is weakening, that the consumer is really taking it on the chin. We've seen consumer sentiment drop in the last few weeks. This is not a great thing at the moment. So it's just kind of interesting to see him and their analysis and their numbers to be a little bit more, upbeat. So what does it say here? So it says Bank of America CEO Brian Moynihan said Wednesday that consumers are continuing to spend and economic growth should be solid, though slower this year. Despite surveys indicating that confidence is at a nearly 3-year low amid increasing worries about inflation, Moynihan told CNBC that spending data shows consumers are still shelling out money, though shifting away from goods and into services. We're in this classic moment where the consumer is saying, I'm getting more pessimistic. And some of the surveys and things like that, he said during a Squawk Box interview. But if you actually look what we're doing day to day, they continue to spend, which means the economy ought to be holding up better than people think. From a number standpoint, that means gross domestic product growth this year of closer to 2%, from recent trends closer to 3%, according to the banking chief. Some of the slowdown will come from President Donald Trump's tariffs, which Moynihan estimated will cut about 0.4 percentage points off growth in the near term before the economy adjusts. However, he calls the 2% level trend growth. That's what we've all been trying to get to for 10 or 15 years after the financial crisis. So we see the consumer continue to be solid, and that should bode well for the economy, Moynihan added. There's a lot of questions out there, and I think that will sort through. But right now, we're not talking about what could happen. We're talking about what is happening. The consumer continues to spend pretty strongly for the first part of the year. So, and then it gets back into the Fed outlook and everything. But again, so kind of interesting comments from the CEO of Bank of America there, Mr. Brian Moynihan. And, an interesting take there. I hope this to be true. I hope this is how things kind of continue to pan out. I hope we kind of, I would not like us to see us fall into a recession. I hope we could kind of, peter along here for a little bit until things start to get a little bit better. But, but we'll see how that has to go. Okay. So now let me just check one thing here for a second, guys. Okay, so now we're going to head into, I want to kind of change gears here. Now we're going to look at, so we've been looking at the Federal Reserve side of things here all night. So now I want to take a look at the Treasury side of things for a little bit. Let's look at Treasury Secretary Bessent. So a couple articles here related directly to him and what he is doing. So Treasury Secretary Bessent says White House is heading off a guaranteed financial crisis. And this was from Sunday, March 16th, updated on March 17th. So this was from about 5 days ago. So Treasury Secretary Scott Bessent said Sunday that the Trump administration is focused on preventing a financial crisis that could be the result of massive government spending over the past few years. What I could guarantee is we would have had a financial crisis. I've studied it. I've taught it. And if we had kept up at these spending levels, everything was unsustainable. Bessent said on NBC's Meet the Press, we are resetting and we are putting things on a sustainable path. President Donald Trump has made getting the government's fiscal house in order a priority since taking office. He created the so-called government of Doge. Still, the U.S. debt and deficit problem worsened during Trump's first month in office as the budget shortfall for February passed the $1 trillion mark. Now, was any of that Trump's fault? No, because they were still operating off of the budget that was passed by Congress and put through by the Biden administration. So it's kind of laughable how, and that's true of any president. Any president, the minute that they step in office in January, they're going to be dealing with the spending budget and everything that was set by the prior administration at the start of the beginning of the prior fiscal year for the government, which is October 1st. So again, they just approved the CR, basically kicking the can down the road through the rest of the fiscal year, and then basically saying that they're going to spend this entire summer working on cuts, and will then, as we get closer to the next budget, which will come rolling in around August timeframe and into September, then the fights are going to get real. As the knives will come out, and basically the Republicans will be looking to dramatically reduce spending. Democrats won't want to reduce spending $1, and things will get interesting. And then we're also going to find out how serious the Republicans really are about spending, or about cutting spending, which I really don't think they're that serious. But anyway, okay. So Bessent noted that there are no guarantees there won't be a recession. The market has been on a tumultuous ride as of late, as Trump's widespread tariffs raise concerns. Again, tariffs. Bessent believes pullbacks like the one the market is in right now are benign, and Trump's pro-business policies will boost the market and the economy over the long run. I've been in the investing business for 35 years, and I can tell you that corrections are healthy. They're normal, he said. What's not healthy is straight up that you get these euphoric markets. That's how you get a financial crisis. It would have been much healthier if someone had put the brakes on in 06 and 07. We wouldn't have had the problems in 08. He's absolutely 100% correct. I'm not worried about the markets over the long term. If we put good policy in place, deregulation and energy security, the markets will do great, Bessent added. I said that 1 week does not the market make. So he's absolutely correct there. And I truly believe that he is absolutely right on the ball there, that if we had just continued with things a little bit longer, it would have been a mess. It would have been an absolute mess. And I don't think, I have zero disagreement with that. Now, this is an article I wanted to show you guys, and this is actually from about 6 weeks ago. This was from February 2nd. And I was kind of holding on to this for a little bit because I wanted to kind of wait for a moment to show this one and bring this one out. So Wall Street is nervous about Scott Bessent's borrowing plans. So new Treasury Secretary has criticized a borrowing strategy that helped calm markets. So this is the point of what he's trying to change. So the prospect of increased borrowing by the second Trump administration has spooked bond investors in recent months. One major concern, how the government will execute that borrowing. At issue is a strategy pursued by the Treasury Department since late 2023 to lean more on short-term treasuries to fund the government. Yes, so Grandma Janet was putting all her money into short-term treasuries, and she was draining the cash accounts at the U.S. Treasury, something that was absolutely unsustainable and was basically bankrupting the country. But I digress for a second. Many on Wall Street credit that approach with calming markets, buffeted by sticky inflation and a swollen federal budget deficit. Yes. So what she did work for a year. It basically staved off catastrophe for a year, but in doing so, and at the same time, put us into a much worse financial situation overall. And she did it. She did it in an effort to try to get Biden reelected. That's why she did it. At issue, or I should say, key members of the Trump administration, however, have expressed hostility to the strategy, as they should, characterizing it as a risky effort to juice the economy. Those include freshly confirmed Treasury Secretary Scott Bessent and Stephen Miran, the president's choice to chair the Council of Economic Advisors. Investors have generally welcomed Bessent's approach, seeing the former hedge fund manager as a potential moderating influence on President Trump on issues such as deficit spending and tariffs. Still, some worry that he might ramp up issuance of longer-term debt, or duration in Wall Street parlance, putting upward pressure on already elevated U.S. Treasury yields, a key benchmark for borrowing costs throughout the economy. That has raised the stakes for Wednesday's release of the Treasury's quarterly borrowing plans. If they're legitimately of that view, that Treasury should have been adhering to a policy of issuing more duration and less bills, then that could be a big deal for yields. But as you will notice, and it doesn't show it here because, again, this was from 6 weeks ago, but in recent weeks, the Treasury yields have actually been declining. They've actually been coming down. If they're legitimately of that view that Treasury should have been adhering to a policy of issuing more duration and less bills, then that could be a big deal for yields. Investors care about the federal deficit because filling a larger budget shortfall requires selling more treasuries. That can drive down the prices of existing bonds, pushing yields higher. Details matter, however. Borrowing in T-bills, debt that matures in a year or less typically has little impact on the 10-year Treasury yield, which is what moves things like mortgage rates. Investors don't expect Treasury to change the size of its note in bond auctions this week. The agency typically telegraphs such adjustments well in advance and said in October that it didn't expect changes to longer-term debt auctions for at least the next several quarters. Investors instead will be checking for changes to that guidance, in particular, whether Treasury at least opens the door to increases in the second half of the year. Many analysts have been anticipating such a move even before the change in administration, given the government's projected borrowing needs. The Congressional Budget Office recently forecast a fiscal 2025 budget deficit of nearly $1.9 trillion. Absent increases in longer-term debt issuance, Treasury would need to rely more on T-bills to meet its funding requirements. T-bills, which are usually considered as safe as cash, offer advances to the government as a low-cost funding tool. A downside is that they make borrowing costs more variable. Demand from investors may also not be unlimited, so Treasury has historically reduced the share of T-bills during economic expansions to leave room for big increases during downturns. T-bills made up around 22% of the government's stock of debt at the end of December, up from 15% 2 years earlier, though still a touch below the long-term average. So again, I just wanted to point this out, this change in strategy, going from basically buying, putting all your money into short-term treasuries and now going into longer-term treasuries, which could have the impact of increasing the yields over time. However, if they do more auctions, increase the size of the auctions, that could help to maybe level things out a little bit, but we shall see. But here is, I wanted to just point this out. This is an oldie but goodie from July of last year. So this was an article that was written by Hudson Bay Capital. So this was called ATI, Activist Treasury Issuance and the Tug of War Over Monetary Policy. And this was the key research paper that basically pointed out exactly what Janet Yellen was doing. And who wrote this? Stephen Mirren. Who's now the gentleman we were just talking about in the article, who's on President Trump's team. And Nouriel Roubini, super famous Dr. Roubini, who wrote the famous book, The Black Swan, who's one of the great economists of our time right now. But let's just pop down here for a second. So ATI, induced accommodation, has loosened the combined stance of monetary and issuance policy. Contrary to the Fed's insistence that monetary conditions are quite restrictive, they are not. And Treasury's issuance policies help explain the persistence of inflation and strong economic growth. So then they go into a review of quantitative easing, and that is very critical because if you understand how quantitative easing works, you're going to understand how ATI, active Treasury issuance, is operating basically as the same thing as quantitative easing, but it does it in a stealth way. Whereas QE worked by removing interest rate risk from the market and hiding it away on the Fed's balance sheet, ATI works by limiting the production of interest rate risk at the source. The net effect, however, is very similar. And then we go, and then basically gets into how ATI drives liquidity and financial condition. And then we go in here, comparison of QE and ATI. And what I just want to look at, let's see here. Let's just look at the risk effects. We'll go to the bottom. So basically transaction works a little bit differently. Portfolio balance channel, a little bit different money supply, but then bond market effects under quantitative easing. bond prices are higher than they otherwise would be. Under ATI, bond prices are higher than they otherwise would be. Risk asset effects under QE, quantitative easing. Other asset prices are higher than they otherwise would be. Under ATI, other asset prices are higher than they otherwise would be. Start to look a little similar here, is it? Political economic framework for QE. Politically independent in principle. Central bank managing the business cycle via financial markets. ATI, politically dependent treasury officials managing the business cycle via financial markets. So again, basically accomplishing the same thing. And then you see, then it gets into like the size of the treasury stealth QE. And again, I'm not going to go through the whole long thing here, but I just wanted to point this out. This is a fantastic piece of research that was done here. If you have a chance, go back to this. I am positive that I will be going back to this article for years to come, because that's how important this particular piece of research was, and it was an impeccable paper that was written here. But okay, let's take a break for a second. And I want to do what I always do at this time, and I want to talk about a couple of things here. So what economic indicators do we have coming up this week? Well, let's take a look. So on Monday, March 24th, we have the manufacturing PMI. We have services PMI coming out on Monday. On Tuesday, March 25th, we get building permits. We get the CB consumer confidence for March. New home sales. We get the 2-year Treasury note auction. We get API weekly crude oil stock. On Wednesday, March 26th, we get durable goods orders. Then we get the Atlanta Fed GDP now for the first quarter, and we get the 5-year Treasury note auction. On Thursday, March 27th, we get continuing jobless claims, initial jobless claims, GDP, goods trade balances, pending home sales, 7-year Treasury note auction. And then finally, on Friday, March 28th, we get the core PCE price index. We will see if the Fed's preferred inflation index, and we will see if that comes down a little bit. It would be great if it does. Personal spending, Michigan consumer sentiment, U.S. Baker Hughes total rig count, and the FOMC member Bostic is going to give a speech at 3:45. So obviously, all of the focus is going to be on the GDP numbers, which a lot of people are expecting may not look that great here for the first quarter. So that's going to be a big one. And it's that the Atlanta Fed GDP now will be looking at the first quarter, but then on Thursday, the regular GDP numbers will be looking at the fourth quarter of last year, of 2024. So obviously a lot of look on that. We'll be looking on some of the labor market numbers, obviously the consumer confidence, the CB consumer confidence, and then the Michigan consumer sentiment. People will be really looking at that to get an idea of what's going on there. I would expect those numbers to probably not be so great, but like I said, we'll see what comes in there. Okay, I wanted to talk about something kind of big that happened this week, and that was something around called a CDFI, Community Development Financial Institutions. CDFIs are basically popular. That they've really popped up here over the last few years. And but then something happened this week. Basically, Donald Trump issued an executive order restricting the Community Development Financial Institutions Fund and some other federal programs to their statutory components and functions. So the EO says the non-statutory components and functions of the CDFI fund, which is housed under the Treasury Department, shall be eliminated to the maximum extent consistent with applicable law. The CDFI fund and other affected entities shall reduce the performance of their statutory functions and associated personnel to the minimum presence and function required by law. The head of each affected entity shall submit a report to the Office of Management and Budget confirming full compliance within several days. The Office of Management and Budget, or the head of any executive department or agency charged with reviewing grant requests by such entities shall reject funding requests for such government entities to the extent they are inconsistent with this order. So that led to a lot of things that came, basically every day stuff coming out. So the ICBA shares CDFI track record with Treasury following the executive order. So following President Donald Trump's executive order directing the Treasury Department to eliminate the non-statutory components of the CDFI fund, ICBA highlighted the critical role that CDFI community banks play in local economies. In a letter to Treasury Secretary Scott Bessent, ICBA noted that while all community banks are the economic engines of local communities, CDFI community banks are uniquely positioned to serve low and moderate income communities, especially in rural areas. The CDFI fund plays a vital role in ensuring CDFIs can serve these hard-to-reach communities. The CDFI impact. As Treasury prepares its response to the White House's EO, ICBA shared data noting that CDFIs financed more than 252,000 small businesses, creating or maintaining over 2.2 million jobs in a recent 5-year period, provided more than $28 billion in loans and investments in a single year, significantly stimulating local economies, and processed more than $34 billion in Paycheck Protection Program loans to support 1.1 million small businesses during the pandemic. So ICBA believes this proven track record is an important context for Treasury as it prepares to respond to the White House EO. ICBA's Senior Executive Vice President and Chief of Government Relations and Public Policy, Ann Balser, wrote, time and time again, CDFI community banks have proven to be incredibly effective in leveraging and deploying their capital to hard-to-reach communities that are overlooked by larger financial institutions. ICBA and groups expressed support for CDFI fund in letter to Congress. ICBA and other groups expressed strong support for the Community Development Financial Institutions Fund in a letter to the bipartisan Senate Community Development Finance Caucus. And then what else do we got? And then finally, we got senators signal bipartisan support for the CDFI fund. A bipartisan group of 23 senators led by CDFI caucus co-chairs Mark Warner and Mike Crapo, if I'm saying that right, reaffirms their support for the Community Financial Development Institution Fund following a recent executive order from the White House. So ICBA and other groups this week expressed strong support for the CDFI fund in a letter to the bipartisan Senate caucus. The groups noted that the CDFI fund's public-private partnership model aligns seamlessly with the Trump administration's goal of revitalizing American communities, promoting job growth, and reducing regulatory burdens. Now, so all that action this week, I will say it this way: it's not usual to see just so many groups just kind of leap into action so quickly within days of something like this happening. Things just don't usually, they could get there, but they don't just normally work that fast. So I'm not quite sure what to think here yet. This is actually, I find this one actually to be somewhat interesting because on the one hand, I think the CDFI does some really good things. On the other hand, I would just be very curious as to how the White House came to this decision. What did they see, or what did they like? In other words, did they feel that either the Treasury in some capacity or some other group could handle what the CDFIs are currently doing? And they just thought that, hey, this is something we can give to somebody else, and therefore we could save the money, don't have to spend all the money on the CDFI organizations. I'm just curious to see what the rationale was, where their thoughts were, why they came to this decision, and if a plausible, rational decision there can be presented, a legitimate argument can come forth, then, hey, that's great. If this was some kind of a knee-jerk thing, then I would definitely be in favor of keeping the CDFIs. So, but like I said, I would just be curious to hopefully this week we'll get some kind of answer from the White House on why they made this decision and why they thought that this was a necessary step. But we shall see. So, all right. Do I want to do the other banking news, or do I want to go? I'll tell you what, let's go over the episodes that I had for this past week. So let's jump in here. So I had 5 episodes this last week. So I started out Monday with episode 342. Basically, consumers lost 5.7 billion to investment scams in 2024. So this episode examines new data released by the Federal Trade Commission on consumer scams for 2024. The official press release is titled "New FTC Data Shows a Big Jump in Reported Losses to Fraud to 12.5 billion in 2024. Consumers reported losing the most to investment scams at 5.7 billion. The top 5 scams included imposters, online shopping, job opportunities, investments, and internet services. Young people between the ages of 20 and 29 were the most heavily targeted. So if you're interested in looking at that, there was actually a really cool infographic that I showed as part of that video. So if you want to go check that one out, please do. And then on Tuesday, I did an episode that was a little bit longer of a usual episode, but and only because I thought that the information in there was really good. And that was episode 343. Can Congress jumpstart de novo bank activity? So, in this episode, examined a recent blog post from the PCBB titled "New Bank Formation May Get a Boost from Congress," and multiple articles on de novo activity from S&P Global Market Intelligence. De novo bank activity in recent years has been dead, and the reason for that is primarily a regulatory one. De novo activity has been muted since the Great Recession from 07 to 09. What do the numbers tell us over the last few years, and what can Congress do to help the situation? Getting de novo banks going again is critical for the future of banking. And I absolutely wholeheartedly agree with that. So, and then for anybody who doesn't know, de novo is just a fancy way of saying startup bank. It's an expression or a term that has been used in the industry for many decades. It's a French term. But it basically just means startup bank. So basically what I'm looking at there in the activity is startup bank activity. And I go back over the last couple of years, just kind of point out some of the different things that have been going on in the industry, why it's been happening, what is the regulation that's causing an effect on this. And then I talk about some of the things that Congress is proposing in the bills that they are putting forth and how that might help to alleviate some of the issues here with forming and starting de novo banks. So next on Wednesday, I went to episode 344, which was called "What is the Cost for Banks to Manage Physical Cash?" So this episode examines a recent blog post from PCBB titled "Cashing Out on Managing Physical Cash." So managing physical cash for banks can be very expensive. Banks must maintain counting machines, vaults, trained staff, and security. And what strategies, thus, can banks use to more cost effectively handle physical money? So, I actually thought that was a pretty interesting episode there. And, in that episode, I talked about the importance of maintaining physical cash. I believe it to my core. We can never, ever, ever give up physical money. As great as maybe cryptocurrency sounds, as great as instant payments are with, if you use Venmo or Cash App or Zelle, whatever the case may be, as great as a lot of that stuff is, we cannot give up physical cash. Physical cash literally equates to your freedom. You lose the ability to have physical cash, you literally lose your freedom. That is how important it is and how important I feel about it. I will never, ever advocate for giving up physical money. Never. On Thursday, we did episode 345, which was called "The Industrial Loan Company. The ILC Charter is Back." So this episode examines a recent article from Bank Director titled "Companies Brush Off Plans for Industrial Banks," and an article from Investopedia titled "Industrial Banks or Loan Companies, Overview and Criticism." So the Industrial Loan Company Charter, or the ILC, is a type of banking charter that is known as a loophole in the industry. The ILC Charter has been heavily criticized for many years and continues to rear its ugly head from time to time. With the recent announcements by several motor vehicle companies seeking to attain an ILC, the topic has returned to center stage once again. So yes, that is a very important topic in the banking industry. And what's kind of funny about that is that the ILC bank charter is kind of like the horror movie serial killer of the banking world, if you will. Like, you just, no matter how many times the banking industry has tried to kill this charter. It just keeps coming back. It's literally like the Michael Myers or the Jason Voorhees of the banking industry. Like nothing can kill this thing. It's like indestructible. Anyway, okay. And then finally on Friday, I did episode 346, which was remaining laser focused on deposits. So in this episode, examined a recent article from Bank Director that was titled "Banks Must Remain Laser Focused on Deposits." So as consumers continue dwindling their savings accounts to combat inflation and interest rates are stuck in neutral, funding pressures remain. Therefore, banks must continue to grow and invest in their deposit franchises. As it is said in the banking industry, deposits are the lifeblood of every bank. Yes, absolutely. So I think that was a very important article because it talked about how as funding costs increased, banks put a lot more emphasis on CDs, and they have a huge amount of CDs that are going to be maturing, and it's going to be imperative that they hold on to that money when those CDs begin to mature. And they've got to continue to invest in their deposit franchise to continue growing deposits because deposits are the lifeblood for every bank that's out there. Period. End of story. So just as important as capital is to a bank, deposits are equally as important. Okay, and then and I got some good things coming out this week. Some really good articles that are really good articles. Some really good episodes that I'm doing, and then also I have an interview with Paul Davis from the Bank Slate, which was just a great interview. I'm really excited about delivering that and bringing that into everybody this week. But okay, so before we get back to a couple more articles, I'm going to just jump into some bank news here. So. The FHFA credit score modernization effort missing key elements. So the Federal Housing Finance Agency's credit score models and reports initiative is overly complex, costly to consumers, and missing key requirements for a successful transition, ICBA and other groups said in a letter outlining recommendations. The FHFA's initiative, which started in October of 2022, includes the validation of two new credit score models, the FICO 10T and Vantage Score 4.0, for use by Fannie Mae and Freddie Mac. It also introduced a buy-merge option, allowing lenders to use credit scores from two of the credit reporting agencies instead of the traditional tri-merge. So ICBA and other groups outlined actions FHFA must complete before moving forward, and namely including data transparency and sharing, a cost-benefit analysis and operational assessment, reevaluation of postponement of buy-merge option, coordination with prudential regulators, and alignment with government lending programs. Now, the episode, I did a whole episode covering that whole topic, which I think a lot of people found really interesting. I got a lot of positive comments back on that one. So the number of that episode is escaping me, but I'll tell you what, I will find it and I'll put it out there for everybody. But continuing on, so rural Main Street reports, so solid job growth, but weak farm income. So Creighton University's index of rural economic conditions increased in March, but remained below growth neutral for the 18th time in the past 19 months. So the rural Main Street index rose to 41.1 in March from 38 in February, and 63% of bankers expected 2025 farm income to be down from 2024. So existing home sales were up in February. So existing home sales increased 4.2% in February, but were down 1.2% from a year ago. Mortgage rates moved a little this past week. I'll have something else on that in just a few moments. Industrial production capacity utilization was up in February. This was actually very good. So industrial production increased 0.7% in February, following a 0.3% increase in January. The Federal Reserve reported capacity utilization moved up 78.2% in February after reading 77.7% in January. Housing starts increased, building permits dropped. So housing starts increased 11.2% in February, but were down 2.9% from a year ago. Social Security announces expedited direct deposit changes. So the Social Security Administration announced strong identity verification procedures and expedited processing for direct deposit changes. So the SSA said it will transition to stronger identity proofing procedures over the next 2 weeks. Individuals seeking these services who cannot use their personal My Social Security account, which requires online identity proofing, will then need to visit the local Social Security office to prove their identity in person. The agency will expedite processing all direct deposit change requests, both in person and online, to one business day, replacing a policy that held online direct deposit changes for 30 days. So good stuff there. Consumer sentiment drops and inflation expectations rise in March. So consumer sentiment fell 11% in March, the third straight month of declines, according to the University of Michigan. Sentiment is down 22% from December 2024. Year-ahead inflation expectations rose from 4.3% in February to 4.9% in March, the highest reading since November of 2022. ISAC warns of savings bond fraud. The Financial Services Information Sharing and Analysis Center's latest weekly risk summary shares details of new U.S. savings bond fraud attempts. According to FSISAC, there is a reported trend where individuals will enter bank branches requesting to redeem fraudulent U.S. savings bonds and in some cases deposit the proceeds of the fraudulent bonds. A Senate panel advanced Falkender nomination for Deputy Treasury Secretary. So the Senate Finance Committee voted 14-13 to advance the ICBA-supported nomination of Michael Falkender to Deputy Treasury Secretary. So we'll see if that individual gets confirmed. So Bill Pulte, or William Pulte, was sworn in to a 5-year term as director of the Federal Housing Finance Agency. So Pulte was appointed to head the agency by President Donald Trump, and the Senate last week voted to confirm the nomination. In a statement, safe and sound housing markets are the foundation of American homeownership. So I will be laser focused on the safety and soundness of our regulated entities as we ensure that the dream of homeownership becomes a reality for as many Americans as possible. Now, to follow up on that, ICBA called on the FHFA to do the following after Mr. Pulte was nominated. They've said that they did not fix what isn't broken with the federal home loan banks by implementing additional barriers to funding or by unnecessarily restructuring the system. End the conservatorship for Fannie Mae and Freddie Mac and ensure they retain their critical roles in the secondary mortgage market. Ease regulatory burden and maintain community bank access to the secondary mortgage market. And reconsider and pause the implementation of recent policies, projects, and initiatives that could be harmful for the housing finance industry, such as the FHFA's credit score models and reports initiative. Now, I basically reported on every one of these items in various episodes over the last 6 months or so. And yes, and I agree absolutely 100% with ICBA's statement. Like, basically don't mess with something that's not broken. So hopefully with Bill Pulte getting in there and heading the Federal Housing Finance Agency, basically hopefully they will leave the federal home loan banking system alone, because if it ain't broke, don't fix it. So hopefully that will be the case. And as I just did, and like I said, just did that episode on the ILC banking charter, ICBA opposes Stellantis application for the ILC charter this week. So ICBA said the application for FDIC insurance from the automaker Stellantis threatens the deposit insurance fund and doesn't serve the convenience and needs of the community. So we shall see what happens with that. Treasury Secretary Scott Bessent said, as chair of the Financial Stability Oversight Council, he will prioritize enhancing members' agencies' supervisory and regulatory frameworks, according to a Treasury readout of Thursday's FSOC meeting. Bessent encouraged FSOC member agencies to refocus their supervision on material financial risks. He also expressed support for ongoing banking agency work to remove reputational risk as a basis for supervisory criticism. So the FSOC meeting also featured discussions on developments in the Treasury market, the potential financial stability consequences of cyber incidents, and the impact of recent natural disasters on the homeowners insurance sector. So, ICBA calls for taxing large credit unions continues to generate headlines. So ICBA's new policy resolution calling on policymakers to end the federal tax exemption on credit unions over $1 billion in assets continues generating media attention with a new article in American Banker. So, and then OCC will cease examinations for reputation risk. This is actually a pretty big thing. The OCC announced that it will no longer examine its regulated institutions for reputation risk and is removing references to reputation risk from its controller's handbook, booklet, and guides. The OCC said these actions support its mission and supervisory objectives without altering its expectations that banks remain diligent and adhere to prudent risk management practices across all other risks. And the agency's statement. So the OCC's examination process has always been rooted in ensuring appropriate risk management processes for bank activities, not casting judgment on how a particular activity may fare with public opinion, said acting controller of the currency, Rodney Hood. Focusing future examination activities on more transparent risk areas improves public confidence in the OCC's supervisory process and makes clear that the OCC has not and does not make business decisions for banks. Yes, I absolutely love it. It's huge. And then finally, USDA expediting $10 billion in assistance to ag producers. So the Department of Agriculture announced it is issuing up to $10 billion directly to agricultural producers through the Emergency Commodity Assistance Program for the 2024 crop year. So obviously great news for anybody in agriculture. So that is good stuff right there. So, okay. All right, hang on a second here, guys. Let's jump back into some articles here. Give me a second. I need a sip here. All right, let's do a few more articles here before we wrap up tonight. Okay, so this was an interesting article here. So nearly 25,000 newer workers fired under Trump agencies. 18 agencies provided the number of terminated workers in sworn declarations filed in federal court following orders to reinstate the terminated workers. Now, let me just say this, 25,000 workers, that's a big number, and it does seem like a lot. But when you consider the number of overall employees in the government, the millions of employees that the government has, 25,000 is nothing. It's less than half of 1%. So as far as I'm concerned, until the government starts getting into at least the single digits, okay, at least until they start getting into job cuts of 1%, 2%, 3%, even up to 5%, you're not really making a dent. So, I mean, so again, I just want to say that to put that into perspective. 25,000, again, is a big number. But in the grand scheme of things, if you pull back the curtain, or I should say pull back the curtain, but if you're at a kind of a 30,000 square foot view, it seems like, I guess the point being is it seems like a much larger number than it actually is at the end of the day. So, so basically, this just says federal agencies have fired nearly 25,000 newer workers, officials said in a court filing. It is the first time many of them have provided official termination numbers. 18 agencies, including the Department of Agriculture, started terminating workers after President Donald Trump took office, and the Office of Personnel Management directed officials to fire probationary workers who were not critical to agency missions. Many did not disclose the number of workers that were terminated. So, obviously, we're going to hear a lot more about this in the months ahead. But I would just like to point something out here. Nobody, and I mean nobody on either side of the article or either side of the aisle, disputes the fact that the federal government is massively bloated and has way too many employees, and that there is a lot of, you could trim a lot of fat there on the edges. I don't think anybody has debated that over the years. And if the left was being honest right now, I'm sure you could go back over the last 30 years and I could find clips of Clinton, I could find clips of Obama, basically saying that, yeah, we can make the government more efficient. We can trim certain areas. We can reduce certain things. So again, I don't think anybody who is legitimately arguing the issue basically says the question is always how deep and how far do you want to go with this? That is the real question. I maintain that, I think you could cut 25%. Some people think that's crazy. I think you could cut 25% of the government employees and nobody would notice. I honestly believe that. I think you could cut 25% and nobody would notice. Or you could take a bunch of those employees and put them to work maybe in places that they're needed, like maybe in the post office, maybe at the DMV, so that they're not, constantly lines out the door. Maybe just reroute them to some places where they could be used in better places. How about we do that? That's a thought. Okay. This is interesting. So the extra reward for owning stocks over bonds has disappeared. There is little sign of crimped demand for equities among individual investors who remain bullish after 2 years of blockbuster gains. So basically, in a nutshell here, there's a premium between basically stocks and bonds. And that premium is basically, you can see from the chart here, is basically gone back to zero. Stocks have really been enjoying for a number of years kind of this premium over the bond market, but that has basically disappeared recently. And that's why I wanted to point this out. So usually over the last few years, stocks have been much more attractive than bonds, but that is not necessarily the case much as it is of currently. So stocks haven't looked this unattractive by at least one measure since the aftermath of the dot-com era. Plenty of investors are piling in anyway. The equity risk premium, often defined as the gap between the S&P 500 earnings yield and that of the 10-year treasuries, turned negative in late December for the first time since 2002 and sat last week at negative 0.15 percentage point. The metric is based on a calculation of how much stocks yield, which is derived by dividing the stock market's expected earnings by its price. The earnings yield is then compared with the yield on government debt. The difference between stock and bond earnings yields shows how much investors are compensated for the additional risk of owning stocks over relatively risk-free government bonds. Over the long term, stocks need to promise a higher reward than bonds. If not, the safety of treasuries would outweigh the risks of stocks losing some, if not all, of investors' money. In recent weeks, a combination of higher treasury yields and soaring equity valuations pushed the equity risk premium into the red. That could pose a threat to the recently rekindled stock rally. In reality, though, there has been little sign of crimped demand for equities among individual investors who remain bullish after 2 years of blockbuster gains. I think you get what you pay for, said Mike Ugino, a 73-year-old retired surgeon in Columbia, South Carolina. High valuations haven't deterred him from scooping up more shares of Robinhood Markets, NVIDIA, and Intuitive Surgical in recent weeks. Despite his age, Ugino keeps more than 80% of his portfolio in equities and said he believes tech stocks, including Tesla and Meta Platforms, can keep powering double-digit percentage gains in major stock market indexes in 2025. I don't think you could sit back and have a 60-40 portfolio. I think that's the Stone Age, he said, referring to the traditional mix of stocks and bonds that was for years considered a safe and steady way to expand one's nest egg. You want to make sure you're invested with these companies that are proven winners, he added. You don't want to bet against these guys. You don't want to bet against Elon. In the coming days, investors are awaiting. Obviously, we saw that already. But again, I just wanted to point this out. I think this gentleman brings up a good point, but it's just one of those like indicators. It's one of those things that you want to look at and you want to keep an eye on because it should play into some of your thinking. It should play into how you look at this. What I would say is that your traditional 60-40 split, and again, I have to, this is a borderline financial advice here. So I have to give my typical disclosure. I'm not a financial advisor. I'm not a CPA. I'm not an attorney. But like I said, if you want to go talk to your financial advisor, if you're feeling more defensive, like if you feel like the market maybe is not going to be so hot this year, but maybe bonds might do okay, you might want, and if you're not already in something like a 60-40 split in your portfolio, maybe you want to go talk to your financial advisor about that. Maybe you want to look into that a little bit and say, hey, you know what? Maybe the 60-40 split might not be too bad. Maybe would be a good time to be a little bit more defensive, so to speak, in my investing posturing, if you will, or my investing strategy this year. That is why we call this the strategy room, after all. So, okay. Why there is no relief ahead for high used car prices. So factory disruptions 3 years ago are coming back to haunt the auto market. So used vehicle shoppers are finding stubbornly high prices at the dealership lot if they can find a car at all. So used car and truck prices rose 2.2% from December to January, while new car prices were flat, according to the Labor Department. It was a significant factor keeping overall inflation stuck at 3%, raising questions this week about whether the Federal Reserve will cut interest rates this year. Prices on both new and used vehicles have come down from the 2022 peak, when vehicles were in short supply because of supply chain problems. The inflation was more pronounced on used cars, though, and they remain pricier than they had been before the pandemic relative to new vehicles. Car dealers and analysts say higher used car prices will stick for a while. A number of factors are depressing inventory on pre-owned vehicle lots, likely extending a seller's market. Yes, obviously we can see in this chart here, the price of new cars on average is basically $48,641, up 25% since 2020. And the average price on a 3-year-old used car is $27,998, a 45% increase since 2020. Yes, obviously not good. The price of used vehicles the price of new and used vehicles right now is insane. When you look at a lot of the new SUVs out there, I mean, they're $70,000, $80,000, $90,000. You have, I think it's something like and again, this is amongst all the car manufacturers, you have something like 32 model sedans now. They're all over $100,000 a piece. I mean, that's crazy. It is hard to find used cars. Pete DeLongchamp, Senior Vice President at Group 1 Automotive, one of the U.S. biggest car dealership groups, said at a Detroit conference this month, it is going to be like that for the next 2 years. A big part of the problem traces back to the pandemic-era vehicle shortages. 3 years ago, car makers pulled away on lease deals in favor of outright purchases, which generally are more profitable. Now there is a hangover effect, a shrinking pool of leased cars being turned in at the end of their terms, a main source of supply for used car lots. The number of vehicles coming back to dealers with expiring 3-year leases will drop 23% this year to a decade low, according to Cox Automotive. It isn't expected to bounce back until 2027. Forecasts show it is a massive contraction of that key segment of vehicles that gets put into the used car marketplace, says Jeremy Robb, a Cox analyst who follows the used market. Another factor contributing to tighter supplies, lease customers are less likely to return their vehicles at the end of their term, Robb said. With used car prices remaining sticky, the predetermined price to simply purchase the vehicle at the end of the lease is often a good deal relative to its market value. So, and then here, fewer off-lease cars coming in. So again, not looking good here for the next few years. I myself am going to be in the market here to get a new vehicle this year, as I've actually been putting it off for probably about 3 years now. So it's time, it's got to happen. And I would say most likely I'm going to probably end up buying a new car, because I'm not going to be probably not going to have a great or easy time finding a used vehicle out there. But this is important, because I actually, one of the things I loved to do was I did love buying that if you could find that 3-year-old car coming off a 1-year lease with somewhere in the neighborhood of 20 to 35,000 in mileage, one owner. I had a great formula there buying those cars. You buy a nice SUV, fully loaded, coming off a one-owner lease. Say the original sticker price was $60,000. You could probably get it for $40,000. Got a nice deal. You bought it. If you held on to that thing for 7 years, you made out pretty good. Probably get that thing paid off in 4 years or 5 years, and then you could probably milk 2-3 years with no car payment before you had to go buy another car. And I had done that formula for a long time, and it has worked out really well, but tough formula to make work right now at the moment. So so we will have to keep an eye on this one. So all right. All right, guys. Well, I am going to go into wrap up mode here now. Had gone far enough this evening. So I'm going to do my 2 things that I usually do here at the end of the night. I've got my story for the evening. So if everybody recalls last week, I've been doing these for the last couple of weeks now. So I started out, I talked about the crisis of 1792, which was the first major Wall Street crisis after the founding of the country. The first U.S. bank failure, which occurred in March of 1908. I talked about that. And then last week, I did Black Friday of 1869, which was an attempted cornering of the gold market, which was a great story. But this week, I'm actually going to go into the Panic of 1907, one of the most famous panics in the history of the country. And this was perhaps J.P. Morgan's finest hour in here. So or is it something that he caused himself? I don't know. Well, I'll get into that. I promise I will get into that in another episode. But let's talk about this, right? So the bank panic of 1907 was a short-lived banking and financial crisis in the U.S. that occurred at the beginning of the 20th century. It resulted from the collapse of highly leveraged speculative investments propagated by easy money policies pursued by the U.S. Treasury in the preceding years. This led to runs on New York banks and trust companies that had been financing these risky investments and to shrinking stock market liquidity as smaller regional banks in turn drew down their deposits from the New York banks. It started with speculators Fritz Augustus Heinz, his brothers Otto and Arthur, and Charles W. Morse schemed to corner the copper market and buy up shares of copper mining firm. However, their plan failed disastrously, resulting in $42 drop in stock price in just 2 days. The collapse of the copper stock alarmed investors and led to a run on banks that Heinz was associated with, as well as the fall of a Knickerbocker Trust, New York City's third largest trust at the time. Its downfall sparked a financial crisis in New York City that would reverberate through the U.S. and international financial system. Without a central bank to fall back on, leading financiers, most notably J.P. Morgan, stepped in and put their own money on the line to bail out Wall Street banks and other financial institutions. This event became the impetus for the establishment of the Aldrich Commission and the famous meeting at Jekyll Island, Georgia, where the foundations for the Federal Reserve System would be laid. The Fed was later created in 1913 on the basis that a central bank was needed to assure liquidity in times of financial strain. Today, the Fed's main duties include conducting national monetary policy, supervising and regulating banks, maintaining financial stability, and providing banking services, as well as printing money into oblivion, destroying the dollar, and crushing the U.S. economy. Oh, wait, I'm sorry. Sorry, I added that last part in there. Sorry. No, the Fed is totally notable. If they're totally noble, I digress. They're totally noble. All right. And then finally, let's go in with our quote of the week. Okay, this is very apropos. How did you go bankrupt? 2 ways, gradually and then suddenly. And that was a very famous quote from Ernest Hemingway. So with that, I will wrap up by basically saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Please be sure to leave your comments, as I always love getting back to everybody. Remember, we are on Rumble, YouTube, and all major podcast platforms. Please be sure to check out some of the other content on the channel. I've got tons of great stuff on there: documentary reviews, movie reviews, interviews, the Lords of Easy Money series, the crypto series, all things banking related, technology and finance. I cover it all, baby. It's all there for you. Lots of great content. I hope you go check out some of the other stuff on there. But I hope everyone enjoys the rest of the weekend. Like I said, episodes coming out as usual all week this week. And I hope to see everybody again next weekend. Have a great time out there. See everybody again soon. Thank you so much again for listening. See you later.